And with that, I think we are ready to begin. Hello, everyone, and a warm welcome to this market update with SKAGEN Kon-Tiki and Portfolio Manager Fredrik Bjelland. Now, before I hand over to him, I'd like to remind you that if you have any questions for Fredrik, please use the Q&A button at the top of your screen. In addition, as always, we will make a recording of this event and send it to those of you who have registered. But now I am really excited to hear what Fredrik has to say. Take it away, Fredrik.
Thank you, Ole Christian, and very warm welcome to everyone to this webinar. I thought we'd follow the tried and trusted format, go through the positioning of the fund and how we are invested, review last year's performance, look at the portfolio as it stands today at the end of January, and then a couple of thoughts on the outlook given all the volatility at the moment on the back of trade tension and new president in the US. So same format as before, same team. So I won't give any more updates on that. We can move on to the investment philosophy. Most of you know us reasonably well by now. It's an actively managed bottom-up portfolio, very strict value focus. And as we'll go through during the presentation, we'll give you a couple of examples of how we do this applied value and use sort of the contrarian lens in which we look at the world and hopefully can deliver differentiated returns. But as always, what we say should be followed by what we do. And here, in terms of the key characteristics of the fund, they remain in line with communicated strategy. The eagle-eyed of you will spot that on the left-hand side, there's been a slight dip in the active share of the fund. It's now 83%, which is at the low end of the 80 to 90% range we've had over the last 10 years. Now, this is almost exclusively driven by our investment in Taiwan Semiconductor, which is a large part of the portfolio, but unfortunately an even larger part of the benchmark at close to 11%. And based on UCITS regulation, we cannot own more than 10% in any given company. Value-based, what does it mean for us? Well, it does mean that over a cycle, you should expect the portfolio to trade at a discount to the market without sacrificing too much in terms of quality. At the moment, despite positive returns last year of around 13% in Norwegian kroners, the portfolio characteristics have remained very attractive, less than 8 times forward earnings and less times 1 times book, which are discounts to the market of about 40 to 45%. One of the reasons we are able to achieve that is our focus on smaller and mid-cap names in the portfolio. As you can see in the dark blue bars, our exposure to so-called giant cap names is lower than the benchmark, but I think more importantly, much lower than the average fund in the category, where almost 70% of funds invested are in these very large companies. We find that the payback on our research efforts and our ability to think differently and see something different is better in the lower end of the market cap spectrum, and we continue to find very good ideas there. So what does it mean from a portfolio perspective? Hopefully some of you will remember this chart. Here we show the 5-year range of the fund in terms of some style characteristics and quality characteristics. The blue dot is the fund as it stands today, and the blue, light blue shaded area is the 5-year range of the fund, and the black bars is the category average or the average fund in the benchmark. As you can see, we keep our value credentials very much intact, both on a relative basis, but also compared with our own history. And as I said, we try not to sacrifice too much in terms of quality when we build a portfolio of lower valuations. And although we are a little bit below on sort of trailing quality metrics such as return on assets, return on equity, and stability of earnings, we are actually towards the very high end of our own 5-year range. So we feel pretty good about the portfolio at the moment, that we've been able to increase the quality of the portfolio without altering any of the valuation characteristics. And on pretty much any metric that you would care to look at in terms of valuation, the discount of the portfolio, this is on Morningstar numbers, is between 40 and 60%, which we believe is an attractive place to start. So if we look at returns, this is at the end of January. As we will return to during the presentation, we had a pretty tough 2024, at least from a relative perspective. That is pretty well reflected in the 5.5 percentage point underperformance before fees. As you can see, year to date, we've had a little bit of a better start to the year, almost 2 percentage points ahead of the benchmark gross of fees. It's no hiding from the fact that absolute returns in emerging markets over the last 3 and 5 years have been relatively disappointing at just for the benchmark 2 to 4%. That is driven by the big drawdown we had during COVID, but also the impact of the Russian invasion of Ukraine, which also hit the fund particularly hard. But as you can see, at least before fees, we've been able to deliver outperformance also on those longer time periods. So let's jump into 2024 and look at what drove the portfolio. First of all, let's just start with the higher level. It was a pretty decent year for risk assets. You can see that it paid off to take risk. Equities did better than fixed income, and basically industrial metals did better than oil. I think the one thing that stands out in this chart is the fact that gold did very well in a risk-on environment. And I think there are multiple drivers behind that rally, probably something to do with the fiscal situation in the US and also emerging market investors continuing to favor the yellow material as a store of wealth, given what happened to some Russian-based investors and their US dollar and euro holdings. Also, emerging market equities, although they did well in absolute terms, did much worse than global equities, which were driven by very, very strong returns in the US market. So how did Kon-Tiki fare within that backdrop? Well, as we entered 2024, we highlighted 3 big parts of the portfolio that we thought would drive performance. The first one was that any signs of a stabilization in China and the Hong Kong market should be taken positively by investors. We were also positioned quite aggressively in Korea, where our hopes for the value up reform were pretty strong, and particularly in the financial sector. The final part that we were positioned for coming into 2024 was an easing in monetary policy conditions in the Brazil. We had a wide range of companies listed in Brazil, but ultimately we believed that the reduction in interest rates would be a kicker for the market. So when we go into the report card for 2024, here's what the individual markets in emerging markets did. First of all, it's worth highlighting yet again that the very wide range of outcomes that we see is a constant every year. Not necessarily the same countries at the same side of the chart, but there is always high dispersion in emerging markets, which we think makes it a good hunting ground for active managers. At the very positive end of the spectrum was Taiwan, pretty much the only large equity market to beat the US market last year. This was driven by the very large tech sector, where TSMC alone accounts for 50% of the Taiwanese market, and it did very well again last year. Perhaps a little bit surprisingly for those who read the news is that Chinese market did pretty well during the course of the year, up 28% in euro terms. That's actually higher than the MSCI World Index, which I think shows that it is possible to have attractive returns if the valuation is low enough without it necessarily getting better. At the other end of the spectrum, weakest markets were in Brazil, in Mexico, and to some extent in Korea. And as you will have guessed from the themes for 2024 slide, those are the 2 things that hit the fund particularly hard. So if we go into those 3 countries that we highlighted beforehand, I think it's it's no hiding from the fact that our positioning in Brazil hurt the fund. Firstly, it was the worst performing market that we were invested in, and also our stock selection within that market didn't go our way, predominantly in the more leveraged companies who are now struggling with higher financing costs as the interest rate cutting cycle became a hiking cycle, and we've also seen a very, very high increase in the longer term rates in Brazil, which means that the equities have suffered. If we look at the second theme, that from a market perspective didn't necessarily do very well. The Korea index in euro terms was down 18%, but actually the fund did much better in Korea than the benchmark, down just 1% on the average holding in Korea. And that was largely at the index level. Samsung Electronics was hit hard, but the fund actually had a much bigger exposure on a relative basis to financials, where we really saw the value up program coming in full force for Korean banks in particular, who all increased their shareholder return targets during the course of the year. And that's something that we've seen continue into 2025. Now, we also must mention that the market did take a little bit of a hit during December in Korea when the martial law was declared by President Yoon. That has since been overturned, and what we've seen is an improvement there again, but clearly the political risk premium demanded in Korea has also gone up and the currency suffered as a result. What did go our way, both on an allocation perspective and also from a stock picking perspective, was again in China, which has been a good hunting ground for us over the last 4 to 5 years. At the index level, the market was very, very strong, but more importantly, our investments in China did much better, largely driven by our exposure to stocks like Alibaba, Foxconn Industrial Internet, but also the oil and gas company CNOOC, which we have reduced subsequently. So here, if we go into the single stock perspective, you can see that our contributors followed very much the markets in which they operate, with the 4 weakest contributors being from Brazil. And then on the more positive side, our 3 biggest positive contributors were all Chinese companies where we had significant stakes going into the year. And you can also see that in the Korean market, we had both some winners and losers. Hyundai Motor has continued to deliver strongly and has also tacked on to the value up program, so delivered strongly in line also with the financial stocks that we own there. But I want to just return to this chart because we get a lot of questions all the time about China. It's a big component of what people are thinking about when investing in emerging markets. So what we're showing here is just the Kon-Tiki portfolio within China in the period 2021 to 2023, when we said we were net buyers of Chinese stocks as they got increasingly cheaper over year. These are in annualized returns. So actually over that 3-year period, MSCI China fell 50% or close enough 50% over that 3-year period. But actually our investments in China did not yield any negative returns and stayed flat. What's interesting, 2024, when the Chinese market did do better than emerging markets, we got paid for our patience, both in terms of having built a bigger exposure to China, but I think more importantly, that our stock picking within China continued to be strong, not just in a down market, but very much so in an up market as well. So we have been paid very handsomely to take that risk there. It's also worth highlighting for those who have read about DeepSeek and how Chinese tech companies are also throwing their hat in the ring in terms of AI, that actually the Chinese part of our portfolio year to date is up 12% in euro terms, which is obviously much stronger than the rest of the portfolio, and a full 3 percentage points more than MSCI China performance year to date in euro terms. So again, we have been able to ride the uptrend in the Chinese market also in 2025. Okay, if we jump into the important thing, which is the portfolio as it stands today, here is our top 12. You can see that the valuation characteristics of the total portfolio, both in terms of the top 12 and the top 35, which account for about 90% of the fund, retain their attractive valuation characteristics, 40 to 45% discount to the market. We haven't necessarily made any big changes to the absolute or the constituents on the top 12, but as you can see in the red arrows down there, we have been actively reducing some of our Chinese exposure, as that has done very well so far this year. And at the same time, we've used our contrarian lens, actually increasing our Banco do Brasil stake, as it has done relatively well, and we expect it to continue to do so, even in a higher rate environment. Also, in terms of the quality characteristics, I think the easiest way to measure that is on the return on equity in these businesses. And as you can see, both on a trailing 12-month basis and a trailing 3-year basis, the portfolio pretty much on a backward-looking basis has companies delivering similar return on equity to the benchmark, but at a much lower valuation. And obviously on our forward-looking independent analysis and our own valuation work, we expect these companies to do better going forward than they have done historically. So we're pretty comfortable with the portfolio the way it looks today, more than 40% upside on our independent target prices, which looks 2 years out. And even if all our stocks were to hit our price targets, you can see on the bottom line that our portfolio would still trade at a discount to the market. So it's not like we are assuming that anything extraordinary happens. We just expect the market to pay the same price or a little bit lower for similar kind of performance that we believe our companies are capable of delivering. If you look at the changes we've done in the portfolio since the last update back in November, it's worth highlighting 4 new investments in the fund. The first one is Polish insurance company PZU. That's a stock that was hit hard last year on floods in Europe and bigger damages to be paid for that. We think that this is more of a one-off hit than a strategic hit. So we think that gave us a good opportunity to enter a high-quality financial group in Poland. We've also invested in the Indian bank Axis Bank during the month of January, alongside the Brazilian oil and gas company Petrobras, and also the Mexican-listed Walmart Mexico and Central America business. I just want to spend a little bit of time on explaining why on earth would we invest in a Mexican business with Trump having entered the Oval Office again, and what he has historically said about the Mexican market. I think, first of all, we've done pretty well by positioning contrarian in Mexico over the last 12 months. Some of you may recall from the last update that we talked about Genoma Lab, which was actually the best performing stock in the Mexican market last year. It had been one of the worst performing stocks in 2023 on the back of its Argentina exposure. Now that exposure is actually seen as an asset rather than liability for the company. So we've seen a material re-rating at a time when the Mexican market has come down substantially. So what do we see in Walmart that makes us want to go into the Mexican subsidiary at this time? Well, first of all, just want to explain. So locally listed businesses of global groups often command a significant premium to their parent companies. So you look in the orange bars, here's a number of examples of well-known brands and well-known companies, and you can see that their Indian subsidiaries trade at premiums ranging from about 100% to 500% versus the parent companies. Now, of course, this is driven by the fact that they often have better long-term growth prospects. Maybe local investors like these businesses because they get kind of a domestic exposure, but they get it with sort of global high quality team management and processes and things like that. But it's very clear here that the Indian market is one in which these subsidiaries are very highly valued, and that's why we were happy last year when Hyundai Motors listed its Indian subsidiary, which had previously been 100% owned by Hyundai Motor in Korea. And you can see it already commands a premium of almost 5 times the valuation of the Korean parent company, which we own. Outside of India, it's more or less the same story. Locally listed subsidiaries trade at a significant premium in the markets in which they operate. Here, the average for food and beverage companies like Nestle, Carlsberg, Heineken is about 25%. But there is one standout company in this crowd, and it's Walmart. And here, the Mexican subsidiary, which used to trade at a premium to the American parent company, now trades at half the earnings multiple of the US parent. Now, why is that? I mean, first of all, there's not much to separate the two in terms of what a Walmart store looks like in Mexico and in the US. You can try and guess yourself or go on Google Street View and see what a Walmart supercenter looks like in Arizona versus what one looks like in northern Mexico. But I can tell you from also having visited the store, there is not a lot to tell them apart. And they operate with the same kind of business model and same kind of management operations. So what is different is that on quantitative metrics, the Mexican business is a better business than the US business. So here we look at the last 5 years growth in US dollars. So this is not local currency, this is a hard US dollar currency. Walmart Mexico between 2018 and 2023 grew by more than 50%, 20 percentage points higher than Walmart did in the US, and 30 percentage points higher than Walmart Incorporated, so the total parent company grew. Now, if you look at profitability, both the operating margin in Mexico is higher than it is for the consolidated group, 8% versus 4%. And here's the real kicker, that the return on investment, or the invested capital, which is one of the key components of management and executive compensation. Walmart in Mexico has a 9 percentage point higher return on invested capital than its parent company. Now, here's what the valuation looks like over time. So although Walmart Mexico may not necessarily screen as screaming cheap on an absolute basis at 16 times earnings, it has been completely left in the dust by Walmart Consolidated, which now trades at 35 times the next 12-month earnings. And when you look at what that means in terms of the discount, it is at a 10-year high or all-time high for Walmart Mexico divided by Walmart, which is in the dark blue line on the right-hand side. But also, Walmart has always traded at a premium to the Mexican market, and also that premium versus the market in Mexico has come down in recent times. So we actually think this is a very good opportunity. You buy a very high quality retailer with a proven business model through ups and downs in terms of macro cycles, and you also have a playbook where one of the reasons why Walmart in the US re-rated and become more highly valued is because of its online strategy and having become a much stronger player there. And we saw similar signs at Walmart Mexico when we visited them last month, that they are really working hard to build a ecosystem around their stores with digital payment solutions, telecom services provision, and more consumer loyalty programs. So we think that they have a very good chance to follow the same kind of playbook that Walmart did in the US, and they are doing it from a position of strength, of higher historical growth and higher profitability, and trading at half the price of its parent company, a really standout opportunity compared to other similar situations. Okay, so that's some examples from the portfolio. We jump into the outlook for 2025. I'm not going to spend lots of time on a lot of different things. I just want to challenge some of you when it comes to trade war and what might be the sort of the reason why some might be worried for emerging markets. Just want to put some data on it, and you can make up your own opinion as to how well placed different regions and companies are. So the first thing to note is that since the last time Donald Trump was elected president 8 years ago, the US or China's trade surplus with the US actually increased by $100 billion. That's despite the trade war in 2018 and 2019. So there is actually not been any change in the structural shift in terms of trade away from China. And more importantly, when you look at the data, China's trade surplus with the rest of the world increased by almost $400 billion in the last 8 years, which shows that even though the US might not want to trade as much with China as it did before, there are plenty of other countries in the world who are very happy to take high quality Chinese goods at attractive prices. Now, what can countries do if they do become embroiled in a trade war? Well, one is to focus on their home market. And here I just give an example that there are many ways to lose a trade war, not just trading with other people, but here you can see the last 5 years, the market share of the 10 best known foreign brands operating in the Chinese car market. They have collectively lost more than 35 percentage points of market share in the last 5 years, as Chinese auto manufacturers, both on the hybrid side and also on the EV side, have become much, much more competitive and competed foreign players almost out of the market. It is something that we have seen in our holding through Hyundai, but also you can see very, very strongly both for European and US operators. So one thing that countries caught up in a trade war can do is to do better at home. The other thing that they can do is to be better in other markets. And here's another example from the auto market. And in the red line, you'll see Chinese export of auto or passenger vehicles compared with those of the US in blue, South Korea in yellow, Japan in black, and Germany in gray. It's the same picture here. China is now the biggest car exporting country in the world at close to 6 million vehicles per year. Now, they haven't done that by focusing on the German market or the US market. Although we see quite a lot of Chinese electric vehicles here in Norway, I don't think we move the needle on a global scale. This is China doing business with other markets in emerging markets. And this is the kind of trade that only companies in emerging markets are winning from. They are displacing legacy OEMs and winning when they have a fair chance of competition, and they can do so without access to other markets such as the US. And here, just to illustrate the point, this is every country in the world showing who their main trading partner is. In blue, it's the US, in red, it's China, and in gray, it's the two countries themselves. Now, if I had shown you this chart for data 20 years ago, it would have been mostly blue. But as you can see now, most countries in the world, their number one trading partner is China. It is not the US. So any kind of escalation of trade war, I think, will play into the hands of China from this global picture, although it will hurt Chinese and other EM countries on the trade with the US. But there's plenty of more trade to be done in the world, as the data clearly shows over the last 20 years. Another example of that is just to think about where are the consumers of tomorrow. So based on some data we've seen, about 113 million people globally entered what we call the consumer class, which is when they can afford to consume more than just basic goods. And again, this is not happening where we are. We are already consuming what we need to consume. If anything, there is pressure on us to consume less in order for sustainability reasons, etc. The increase in consumption is predominantly coming from Asian markets. And again, this is where emerging market countries, emerging market companies are building brands, are building supply chains. And as the data shows, they are doing very, very well in this type of trade. And they are displacing a lot of the companies that sit in your average developed market portfolios. So that was just a quick run through, all we had time for this time. There is no change to our overall message. The fund tries to stay very, very true to its actively managed investment philosophy. We focus on the long term, we are data driven, value focused, and we are looking for long-term sustainable returns. We have built a portfolio that we believe reflects the strategies we communicated, a collection of companies that are often unpopular, but they are very, very clearly on our independent analysis undervalued. We show that the overall portfolio characteristics give you a very good trade-off between quality and price that you pay for it. And I think increasingly, as the narrative around emerging markets seems to be a negative one based on how can they lose from a trade war, I think it is worth trying to lift lift the horizon a little bit, look at what the data is telling us, and see if we can find some actual winners and not just losers in what is a ever-changing global backdrop. So thank you very much for your attention. I hand it back to Ole Christian for further remarks.
Thank you very much indeed, Fredrik. Now, if you have any questions for either Fredrik or indeed any of our other funds, please do not hesitate to get in touch with us, and we'll help you to the best of our ability. I guess we're done for now. So thank you very much for watching.